Hi everyone, Michael here and welcome to Smart Money Hub. Today, we're diving deep into a topic that affects everyone, whether you're a seasoned investor or just starting to think about your finances. How money is actually created in the United States, who is responsible for it, and why it matters to you. Have you ever wondered where money really comes from? Most people think that money is simply printed by the government, handed out, and then spent in the economy. But the truth is far more complex, fascinating, and critical for understanding how our economy works and for making smart financial decisions. Let's start with the basics. Money at its core is a social agreement. It's a tool we use to measure value, exchange goods and services, and store wealth. Without this shared understanding, a dollar bill would just be a piece of paper. But in today's world, money is mostly digital. Over 90% of all money exists not as physical cash, but as numbers in bank accounts, ready to be transferred instantly with a click or a tap. So, who actually creates this money? The first answer that comes to mind is usually the Federal Reserve, the central bank of the United States. And yes, the Federal Reserve plays a critical role, but it doesn't create most of the money you use every day. In fact, the majority of money in the US economy is created by commercial banks when they issue loans. Let me break it down for you. Imagine you go to a bank to take out a loan for a new car. The bank doesn't hand over piles of cash from a vault. Instead, it creates a deposit in your account, a promise that you can spend that money. At that exact moment, new money has been created. The bank's balance sheet expands and the money supply in the economy increases. This process is called fractional reserve banking, and it's one of the most important mechanisms behind the economy. Fractional reserve banking works because banks are only required to keep a fraction of deposits as reserves, typically around 10% or less. The rest can be loaned out, creating new deposits in the process. This creates a multiplying effect. If a bank receives $1,000 in deposits and lends out $900, that $900 eventually gets deposited in another bank, which can then lend out $810, and so on. This is how the banking system generates far more money than physically exists in cash. Now, let's talk about the Federal Reserve. The Fed has the unique power to create money directly, but it does so mainly through open market operations. This means buying government bonds from banks, which credits the bank's reserve accounts. Banks then have more capacity to lend, creating even more money in the economy. The Fed also sets key interest rates, influencing how much banks are willing to lend and how much money people are willing to borrow. When we say the Fed prints money, it usually doesn't mean physically printing bills. Instead, it increases bank reserves, making it easier for commercial banks to expand credit. These actions are part of monetary policy, used to control inflation, stabilize the economy, and influence employment. Understanding this process is crucial because money creation affects everyone. When banks create more money through lending, it can stimulate economic growth, but it can also lead to inflation if too much money chases too few goods. Conversely, when lending slows, the economy can contract, and deflationary pressures may appear. Your mortgage, credit card, and car loan are all connected to this system, and changes in the money supply can directly affect your monthly payments and the value of your savings. Money creation also has a global impact. US dollars are used worldwide, and decisions made by the Federal Reserve influence not just domestic interest rates, but also currency exchange rates, global trade, and international investments. That's why understanding how money is created in the United States isn't just an academic exercise, it's essential for anyone who wants to master finance. Let's discuss the risks. The system relies heavily on trust. Banks create money by issuing loans based on the assumption that borrowers will repay. If borrowers default on a massive scale, the money they created disappears, and banks can face a crisis. The 2008 financial crisis perfectly illustrates what can happen when confidence in the banking system breaks down. That's why regulations exist to ensure banks maintain capital and manage risks. Money creation is powerful, but it's also fragile. The role of digital money is also fascinating. With the rise of online banking, payment apps, and now cryptocurrencies, the nature of money is evolving. Central banks are exploring digital currencies, which could change how money is created and tracked, raising questions about privacy, control, and monetary policy. Why does this matter to you, the viewer? First, Understanding money creation helps explain inflation, interest rate changes, and why your dollars may gain or lose value over time. Second, it highlights the importance of debt, not just at the national level but in your personal finances. Every loan you take contributes to the money supply, and your decisions influence the broader economy more than you might think. Third, it equips you to think critically about financial news. When headlines talk about printing money or quantitative easing, you'll know what that really means. Government spending interacts closely with money creation. The U.S. Treasury issues bonds to fund programs, and the Federal Reserve can buy these bonds to inject liquidity into the economy. This is how the government finances deficits without immediately raising taxes. While this can boost economic growth, it also adds complexity to understanding money creation, as government debt and central bank actions are deeply intertwined. When the Fed lowers rates, borrowing becomes cheaper, stimulating loans and increasing the money supply. When rates rise, borrowing slows, contracting the money supply. This delicate balancing act affects businesses, consumers, investors, and the stock market. Understanding this can help you anticipate economic trends and make smarter financial choices. Let's explore money supply metrics like M1 and M2. M1 includes cash and checking deposits, while M2 adds savings accounts, money market accounts, and other near-money assets. These measures help economists track money circulation and predict inflation, spending, and investment patterns. As a viewer of Smart Money Hub, knowing these metrics gives you a clear picture of economic conditions and the context behind financial news. There's also an ethical side. Money creation gives banks, governments, and central banks enormous power to shape economies. This power can promote growth and stability, but if credit is not accessible to everyone, it can exacerbate inequality. Understanding how money is created lets you question policies, advocate for fairness, and make informed personal financial decisions. Looking ahead, the future of money creation may involve technologies like blockchain, programmable money, and AI-driven monetary policy. These innovations could revolutionize how money is issued, tracked, and controlled, creating both opportunities and risks. Staying informed is key for managing wealth and navigating the financial landscape of tomorrow. History is important too. For centuries, coins, precious metals, and bills were the main forms of money. But the modern system of bank-created digital money, guided by central banks, is less than 150 years old. It has transformed societies, government financing, and personal wealth management. By understanding this system, you gain a powerful tool for making smart financial decisions. Next time you check your bank account or consider taking out a loan, remember this. Most of the money you see didn't exist before you borrowed it. It was created at that moment, expanding the money supply and fueling the economy. This system is one of the most powerful forces shaping daily life, even if we rarely think about it. In upcoming videos on Smart Money Hub, we'll explore how the Federal Reserve's policies directly influence inflation, how quantitative easing works, and how the global financial system is interconnected with U.S. money creation. Understanding this is key to mastering finance, investing, and personal wealth. Money creation is not just abstract, it's the engine behind economic growth, financial crises, and the value of your paycheck. By learning how it works, you gain insight into one of the most important mechanisms driving modern society. Let's look at real-world examples. During the 2008 financial crisis, the Fed injected trillions into banks to prevent a collapse. This increased the money supply and stabilized the economy, but also sparked debates about inflation, moral hazard, and long-term consequences. Another example is the COVID-19 pandemic, when governments and central banks rapidly increased money supply to support businesses and individuals during lockdowns. Stimulus checks, low-interest loans, and quantitative easing created unprecedented amounts of new money, preventing a deep recession but contributing to inflationary pressures today. Money creation also affects investing. Understanding central bank policies, interest rates, and bank lending dynamics helps investors make smarter decisions about stocks, bonds, real estate, and other assets. Investors who grasp these dynamics are better equipped to manage risk, identify opportunities, and protect wealth during economic shifts. By mastering the concepts behind money creation, you are not just learning about banking or economics. You are gaining a framework to understand the world, make informed decisions, and navigate modern finance. So that's it from me, Michael, here at Smart Money Hub. Understanding money creation gives you the insight to make smarter choices, protect your wealth, and see the hidden forces shaping our economy. Stay tuned, because we're just getting started and there's so much more to explore about money, finance, and power.